I sit on the AltX Advisory Committee, and I see companies like a lot of yours coming to present to me to motivate why they should be listed on the AltX. And when we ask why they want to list, the reasons that they often give is that they want to elevate their company into the public eye, they want to gain credibility in the eyes of financiers and suppliers, they want to attract and incentivize good staff. And in my view, those are all very good and peripheral benefits. But when things go wrong, they can certainly work against you. So the main reason for me why you want to list on the stock exchange is that you want to do one of two things. Either you want to raise capital immediately, or you want to position yourself where you are able to raise capital, or you're creating a currency in the form of your own shares to go out and do M&A transactions. For whether you want to facilitate growth, for future expansion, or raise money for working capital, and so on. So for you guys, for the existing shareholders, the price at which your company is going to list is going to determine is going to be based on value, and it's going to determine the extent to which your capital raising efforts are going to either enhance or dilute your shareholder value. And when we're doing these valuations, we speak a lot about advisors, and one of the main roles of an advisor in a listing process is to do your valuation and assist you with the pricing considerations. There's a lot of focus that's put on, and rightly so, on sustainable profitability and operational cash flows, and those are certainly very, very critical drivers. But the other one that perhaps you think less of, rather than profitability, is actually your balance sheet structure and how this impacts on your valuation. And this is what we mean by optimizing your balance sheet. So let's have a look at a balance sheet. So, this is a balance sheet before the new age accountants got hold of them. This is how I understand old employment of capital and capital employed. And the reason that I like looking at balance sheets like this is, for me, it tells you, you're able to read it a lot easier. So on the left-hand side, we've got your operational assets that are producing the cash flows that are going to be involved in your valuation, and cash, which obviously is valued at its face value. And on the right-hand side, you've got what you call your capital structure. This is what we're going to optimize. So capital structure, it's a mix of debt and equity, and I've heard a few comments about whether you have a lot of debt or you have a lot of equity, which is bad and which is good. Well, the good thing for banks, I guess, is that debt is an important part of your balance sheet and part of your capital structure. You're funded by money that is put in by banks or by bonds, by the debt capital market, and you guys have a debt capital market here. And the money that is put in by shareholders, and both of them come at a cost. And why does this cost actually matter? Who cares? Well, because the value that your advisors are going to produce is really a function of your cash flows, the cash flows that are coming out of the assets. So that assets are the operational assets, the fixed assets, your factories, your working capital. So that's your debtors minus your creditors and so on. So those are the operations and the cash that's being generated by them, divided by your cost of equity. So just on a very simplistic mathematical basis, obviously the lower your cost of equity, the higher the value of your company. And that is why it matters. So obviously what you're going to do is say, well, which is the cheaper of the two? And there was a great comment earlier about banks not taking any risk. Well, the banks actually demand less of a return, I guess, because they take much less risk. The reason that they do that is because the debt ranks ahead on liquidation. Very often debt is secured. And also that the interest payments, the cost of the debt, generally, well, they always come before dividends. So they rank ahead from an income perspective over shareholders. So that is why your cost of debt is cheaper, along with the fact that your cost of debt is tax deductible. So does that mean then you can have as much debt as possible and the shares of your company are worth more? Well, up to a point. And let's have a look at an actual example. So as debt and equity providers are pricing the capital that they're putting in, as you have more and more debt, you introduce a great deal more financial risk. So again, this is very dependent on the industry in which you operate as to how much debt you can actually assume. And this is a real live example. It's a listed company, and you'll see there that the more debt that is introduced into the capital structure, so the debt providers are actually pricing for risk. They're actually going to charge you a higher interest rate. And the shareholders, as the company becomes more financially risky, are going to require higher returns. So when shareholders require a higher return, generally your share price is going to go down. And so as your gearing goes up, so the cost of your weighted average cost of capital is going to rise at a certain point, after a certain point. So in this particular example, and bear in mind, it's always very company specific and very industry specific. For this particular company, they have calculated that their optimal capital structure is about 40% debt and 60% equity. That's how they finance their assets. So this is great. This is great in theory, and it's relatively simple, and I've explained it to you in about 3 seconds. It's very easy to calculate, but when you're going to market, there are a lot of other things that you need to consider. Certainly, right, let's go through these. Sorry, I'm very mindful of the 20 minutes that I have. So now you're a company that has worked out your cost of capital, and you need to decide how much that you want to raise on listing. There are a couple of factors to consider. The first of all is timing. So at the moment, and I'm speaking from a South African perspective, at the moment we're going into an upward interest rate cycle. In those instances, you need to look forward and you need to say, well, if I'm highly geared, or if I'm very operationally volatile, how much debt can I sustain? So you may well have a point-in-time balance sheet that, and some theoretical calculations that say that 40% is a good number. But if we're expecting cost of debt to rise, or we have a very volatile type of operation, maybe that's not such a good number. The next thing is peer review. If you're going for a listing, between you and your advisors, you're going to be looking at who else is listed in your sector, and benchmarking against your peers. So, once again, you might do a theoretical calculation and come up with your theoretical capital structure. But a good example of this would be, if you look in South Africa at the moment, we've got a proliferation of inward listings of foreign European property portfolios. And at the moment in Central and Eastern Europe, you've got a scenario where the property yields are very high, so you're able to buy property relatively cheaply. And the interest rates are incredibly, incredibly low. And in that scenario, and they look to be like that for some time, in that scenario, it makes an awful lot of theoretical sense to be going very big with your gearing, because the cost of debt is incredibly low. But South African investors are quite wary of very highly geared property funds, and you're unlikely to get your listing away where your theoretical optimal capital structure outlies heavily against its peers. So it's always critical that you have a look at what investors are considering is optimal. Just remember that when you're coming to market, you are competing for capital. You're competing against other companies for capital, and you are trying to design a product, because your listed share is actually a product, an investment product that the investment community is wanting to invest in. So you try and make it look and feel like something that the investment community wants to invest in and is used to seeing. The next thing to consider, the next thing to consider is what the market demand is at the time. So you go through situations where there's an awful lot of excess capital in the market, and this capital will literally follow any sort of listing. I think the South African property sector in the last 10 years has been very successful because there's been a great demand for yield. And so you've seen a huge amount of investment into that particular sector. By way of example, Quesco recently listed a company called StoreAge. It's a small cap, niche property counter. It's a REIT. It's very different to anything else that has been listed in the property sector in South Africa. And we went to market. We had a look at the balance sheet. We had a look at what the peers, what the sort of general gearing levels were in the industry, and we settled on about 700 million that we wanted to raise. When we went out to market, we came back with commitments for 2.3 billion. It was more than 3 times subscribed. And we had to actually look at this and say, well, we know what our optimal capital structure is, but a balance sheet is something that is static. It is at one time, and we had to look at where the market was going. We knew we were listing into an interest rate cycle that was moving upwards. We thought that it may be a bit more difficult to raise capital going forward. Here was a lot of money being thrown at us, and we decided that we would actually take a little bit of that extra. So into our prospectus, we wrote an ability to take more than what was initially offered to the investment community. We gave ourselves flexibility, and that's quite an important thing when you're looking at a listing, to make sure that if you have a very successful listing, that you are able to perhaps take a little bit more on the day when it's thrown at you. So why didn't we take all 2.3 billion? I think, there were a couple of reasons. One is that when you're taking money from the investment community, you need to be absolutely certain as to what you're going to do with it. The investors are not giving you money for it to sit on your balance sheet. They can just give it to a bank and sit on deposit. So we had to look at the pipeline. This in particular is a property company. We had to look at the acquisition pipeline, and we had to look at the growth in the short to medium term and balance that off against the amount of money that we could possibly raise. In the end, we only took another 300 million, so we raised just over R1 billion. One of the other critical factors is shareholder dilution. So the reason that we didn't take more than that over and above what we could spend it on was because the entrepreneurs who had built this company over a decade had actually worked very hard to create this value for themselves and didn't want to lose control. And I think there have been some really, really interesting discussions this morning about what it means to go from an unlisted entrepreneurial type of entity to a listed entity where you lose a degree of control. You have in theory, if you're complying with King, you have a majority of independence on your board. You are subject to the listings requirements that require you to ask permission of shareholders for various transactions. And in some cases, those transactions, as entrepreneurs, you may find that the transactions don't necessarily go your way. So in StoreAge's case, they wanted to, the entrepreneurs who founded the company wanted to keep a strategic shareholding of 25% plus 1. And so they took as much capital that they could, bearing in mind the acquisition pipeline, and then with a maximum that would get them not through that particular threshold. And what this gave them, in spite of the fact that in theory they are way undergeared in terms of the calculations I've shown you, what that's given them is some firepower, some acquisition firepower. They can then go and gear up in future against the extra capital that they've raised. So they haven't actually just raised an extra 300 million, they've raised the 300 million plus the gearing capacity that additional capital has given them. What is important, I think, for you guys who are looking to list is in your messaging to shareholders when you are giving your sales pitch with your advisors, when you're raising the capital, written into your prospectus, you will message to the market what you think is the maximum gearing that you as a company would want to take. It's not something that is regulated. It is not something that is written into the listings requirements, but it is good messaging to the market as to how much financial risk you as a board are prepared to take. It gives them an indication as to their risk appetite. Of course, the other very, very important feature in a listing is liquidity. And liquidity has popped up, that word's popped up a number of times in the course of the morning. I always say, actually, if you thought size didn't count, it actually does. And what I mean by that is generally what you find, and I'll just pull up this graph, what you find is that the bigger companies are more investable. So investors rather like to be able to not only get in on an IPO, but they also need to get out. A lot of your investors are big funds who have investment mandates, who have calls on their cash. They need to be able to sell their shares when they decide to. And therefore they attract big companies, or liquid companies attract a premium in their pricing because a shareholder is willing to pay more for a company or an investment that they can get in and out of with greater ease. And so what this graph is showing, and I apologize for you, those of you who are not in the property sector, my niche sector, although I advise across all sorts of sectors, my niche focus is real estate and particular listed REITs. So this is showing yields. Now, yield is merely an inverse of a price earnings multiple. So if you're at the top, if you're in the blue line, that's bad, and if you're on the orange line, that's good. And this is just showing you a relationship between the larger, more liquid property stocks on the JSE and the small caps on the JSE. The two in the middle are two specialists. So one is Storage and one is Indley Place, which is a specialist housing fund. So what did we do from a storage perspective to try and counteract this illiquidity problem? The first issue was we were able to raise a fair amount of capital, a very large amount of capital compared to what the owners were sitting in. So they were happy to dilute right down, and there was a lot of demand, so we were lucky. So the free float of this company is roughly 60%. So although it's a small cap, its market cap is only 1.2 billion. Although it's a small cap, it's got a very large tradable portion of its shares. The other thing that we did was make sure that that capital was spread far and wide. So we've got a very large shareholder register. In the old days on the JSE, and I'm not so sure if it's still like that on the Botswana Stock Exchange, but in the old days, the JSE required a main board listing to have at least 300 shareholders. And that was to allow tradability. What used to happen is in our corporate finance, I used to work for Standard Bank Corporate Finance, we used to have a whip around in the office and a bit further out beyond our Chinese walls to get one share in the hands of at least 300 people. In fact, in the very old days when I was a lot younger, it used to be 500 people. And it was incredibly hard to achieve 500 people. These days, the JSE only requires a reasonable spread to allow for reasonable liquidity. So there's no actual definition other than 20% being held in the hands of the public, which has a specific definition. For Storage, we achieved 60%, and I think we have about 500 shareholders. So again, we go back to the importance of advisors. Your advisors are there to assist you with placing those shares as far and as wide as possible to ensure liquidity. Liquidity undoubtedly has an impact on your share price. So, in terms of your capital structure, you've got the very potted version of how capital structure influences value. and why it's important. There's obviously the theory, and you will always start with your theory. Your advisors should sit down with you and do a comprehensive valuation using comprehensive valuation techniques that are appropriate for your company and for the sector in which it operates. And valuation obviously differs from price. So the valuation is merely a starting point. The pricing will be influenced by a number of external factors, and ultimately your advisors will assist you in going to market. What I found was quite interesting as well, with RMB saying that there have been 2 counters that have actually been pulled this year because of the volatility in the equity capital markets. So my message to you guys that are wanting to list: advisors, critically important, and I love Max's comment that actually this is not this is a cost that creates a platform, an ongoing platform. And listing is great. There's so many benefits to listing. It's a whole different world out there in terms of growth ability. But if your listing and your pricing, which all goes down to value and your timing, if that's screwed up, the market remembers it for a very long time. So do your homework, make sure you have competent advisors, make sure that you consider very carefully where, when you're going to list and how much you're going to raise. It's not just a theoretical exercise. Thank you very much.